Herkese merhaba. Bu bölümde küresel piyasalara özel bir parantez açalım. Carsten Brzeski ile buluşuyoruz. Kendisi ING'nin Küresel Makro Araştırma Başkanı ve Euro Bölgesi Baş Ekonomisti. Hi Carsten, thanks for joining our program.
Yeah, thanks for inviting me.
First of all, what is the balance sheet of this war till now, and what is the biggest price tag for world economies in general?
Well, I think the biggest price tag is that last year we always were talking about geopolitical risks, geopolitical uncertainty, but hardly anything happened on the real economy, on the stock markets. Now the price tag is oil prices. And oil prices are also the best link between geopolitical uncertainties, a war, and on the other hand, the macroeconomy and global markets. Because it's very clear that the longer this war lasts, the longer the disruptions of the Strait of Hormuz last, that a short-lived energy price shock could clearly develop into a big stagflationary issue for the global economy.
So we're always focusing on the inflation side of this, but on the growth side, do you expect downgrades in terms of growth in the coming months or weeks?
Yeah, a stupid economist's answer, it all depends. If the war was really open over the next would end over the next couple of days and the Strait of Hormuz would gradually open, then I think we could withstand without any significant downward revisions on growth. But if this lasts a little bit longer, and I think we are moving into this base case scenario right now, then yes, we will see more and more downward revisions for global growth. And we also know which regions will be hit the most. This is Europe, this is Asia, this is to a lesser extent the US economy, and that is obviously the entire Middle East region.
As ING, have you changed your expectations in terms of growth and inflation yet?
No, we're in the midst of it. So we released our last forecast actually only a few days after the war had started. Back then, we still assumed that it would be relatively short-lived. We only made very small upward revisions to inflation, very minor downward revisions to growth. But if we're moving now into the next week, and it turns out, what I'm afraid, that the war will continue, and it's not over after 2 weeks, but we're moving into our kind of middle scenario, which assumed at least 4 weeks of combat action, and then another probably 4 weeks of only a very gradual opening up of the Strait of Hormuz. In this scenario, we will have to revise downwards our growth forecasts for Europe, also slightly for the US, and we'll definitely also have to revise upwards our inflation forecast for both Europe and the US.
So what do you expect right now in terms of growth and inflation for Euro? Because Europe is very important in terms of Turkey's trading partner. That's why I'm asking.
Right now, we still see Eurozone growth between 1 and 1.5%, so 1.2, 1.3%. And that is still a story which shows that we have a rebound in manufacturing. That is still the narrative in which we will get a big fiscal stimulus in Germany, in which then investments in defense and also infrastructure will boost not only the German economy, but the entire European economy. Obviously now, with this new uncertainty, with the rise in energy prices, this story is at risk. And just to give you some numbers, I think a rule of thumb is a oil price increase by 10% normally shaves off European GDP growth by 0.1 percentage points. So this already gives you a direction in which we will probably also be moving. So if the war still continues next week, if we have to shift in a more adverse scenario, then I think our European growth number will also probably slightly drop below 1%.
So next week, we have lots of interest rate decisions, and money markets have flipped from pricing rate cuts to wait and see, and even hikes in a span of few days' time. So how have your expectations changed in terms of Fed, ECB, and Bank of England?
Yeah, here we also think really along different scenarios. Base case for now is that next week we won't see any changes. So I think all central banks will remain on hold. We also know which central bank might have been the closest to another rate cut. That was Bank of England. Maybe we're going to see one rate cut there. But especially when it comes to the Fed and also to the ECB, we don't see any action already next week. And how come? Well, it's simply too early. And I think all central bankers around the world are currently grappling with this idea. Okay, should they look through oil price shocks, or should they go for a preemptive rate hike in order to also underline and to stress their own inflation-fighting credibility or credentials? And there will be differences. Well, if we end up in the more adverse scenario regarding the war and oil price developments, I think we could see a divergence of central bankers. Because don't forget, the Fed has a dual mandate. So if growth is affected more also by higher energy prices in the US, I would think that the Fed could actually engage in rate cuts despite increasing inflation. And how come? Because the interest rate level in the US is still much higher than in Europe. Plus, it is the dual mandate that the Fed has to follow. In Europe, the European Central Bank has a completely different challenge, because here also the memories of the 2022 episode are still pretty much alive. And if we are in this more adverse scenario, I can definitely see an ECB engaging in one or two rate hikes, simply a kind of preemptive strike in order to prevent second round effects from materializing.
So what will happen to euro then?
Good question. In our base case scenario, and we had later down the road 2 rate cuts by the Fed, no rate changes by the ECB. So this should normally mean a slight strengthening of the euro. But we also know, as long as oil prices are at their current high levels, this is always beneficial for the dollar. So we would probably hardly move. If we were to see an ECB starting to hike interest rates and the Fed continuing with more rate cuts, then obviously we might see the euro moving back to 120. But I think the days in which people expected the euro dollar to move above 120 by the end of this year are clearly over.
By saying clearly high oil prices, what do you mean? Do you mean over 80%, or you're talking about $100 scenario?
In our adverse scenario, so if we are ready to see a disruption or a complete blockage of the Strait of Hormuz by 4 weeks or even more, we are talking about oil prices of more than $100 per barrel. The longer it lasts, obviously, the higher these prices will be. But it's not only about oil prices. Don't forget that. It's also about gas prices. Yeah. And these higher gas prices are also very relevant for the European economy. Because, the European economy, or most Western economies, have clearly become less energy intensive. They probably could live for a while with higher oil prices. But in Europe, the gas storages are at record low levels now that we are leaving the winter season. They have to be filled up again over the summer. So these low storage levels combined with high gas prices are also another potential growth risk for the European economy.
In terms of countries and regions, some say that Eurozone economies are more vulnerable and paying the biggest price tag. Do you agree?
Yes, I do agree, because this shock comes at the worst of all times, because the European manufacturing sector was just about to get out of this long stagnation, and we were seeing this light at the end of the tunnel. At the same time, we were also kind of banking on European consumers to spend a little bit more and to also drive the European economy. Now, with these oil prices, it's obvious the rebound in manufacturing is being put at risk. Plus, it is consumers who will feel higher energy prices immediately. Just look at gasoline prices at European gas stations currently, skyrocket high. So this has an imminent impact on consumer disposable income, and hence also on consumption. So Europe is clearly feeling it immediately. The next region also clearly feeling it is clearly Asia, because when you look at the flows of oil going to Asia. It is also very high. It is relevant. And there are even, I think now the risk in Asia is that some of the production facilities in the manufacturing sector are simply running out of energy and then might not be able to catch up at a later time, but that we then would be really talking about lost production in some Asian countries.
Carsten, Brzeski, thanks for joining our program.
You're welcome.
Yes, I think we are done. Thank you so much.
Very
Thank
good.
you for making
You're
this
welcome.
time. Yeah, I will
You're
let you know
welcome.
about the timing, but possibly 12:30 London time.